So we are back now.
Yeah.
Before we went on a short break, we are discussing the alternatives to money, and then we looked at mobile payments. Now we'll be our main focus this lecture now is to take a look at the what we call the money supply. But before then, let us briefly and quickly cover these forms of mobile payments. So we have the Apple Pay. I believe I mentioned it before. In this case, if you have Apple Pay, you can make payments when you're checking out by just scanning your phone, and then the payment will go through the retail online or the retail or store checkout devices. So now, the other one is the Google Wallet. Is another type of mobile payment that is developed by Google, and it allows users to store debit card, credit cards, loyalty cards, and gift cards on their mobile phone. So again, just like the Apple Pay, you can use it to make payments both online and at the stores. If the store have the kind of payment system that accepts it. Now, we can now go to our main focus, which is the measuring and tracking money supply. Okay. In the US, in the 19th century US, there was no monetary. I mean, I would say there was no unified or nationwide monetary systems. So that means that buyers and sellers who travel from state to state have to carry multiple currencies. So if you're going to, let's say you're going to Maryland, from Maryland to Virginia, you have to carry the currency that can be accepted in the state of Virginia. So that means you cannot use the currency that Maryland has used to buy things in Virginia. That's how it was in those days. The Confederate State of American dollar was issued by the newly formed Confederacy just before the outbreak of the Civil War. Before the outbreak of Civil War, some of the states decided to secede. That decided that they will no longer be part of US, and they call themselves the Confederate States. So they developed the dollar that we'll be using, but it wasn't backed by a hard asset like commodities. The kind of currency used in Britain and other European powers were backed by hard commodities like gold. So the British pound, the French francs in those days, if you have let's say you have a country have 6 million francs in circulation or 6 million pounds in circulation, that means they must have 6 million ounces worth of gold to back it up. But the Confederacy currency doesn't have that kind of thing. So it didn't really and besides, the Confederate States didn't win the war. So that currency just disappeared like that. But during that time, though, states like Alabama, Arkansas, Florida, Georgia, Mississippi, South Carolina, Tennessee, Texas, and Virginia printed and circulated their own currencies. So anybody traveling to multiple states must carry multiple currencies, so that when you come to Virginia, you use their own currency. When you come to South Carolina, then you use the currency that is accepted in South Carolina. So it wasn't until the 1863 when President Lincoln signed the National Banking Act. It was only that time, after he did that the federal dollar was established as the sole currency of the United States. So now, having given you this background, we can now we're in a good position to define the term money supply. So money supply can be defined as the entire stock of currency and other liquid instruments that circulates in a country or an economy at a particular time. So the entire stock of currency and other liquid assets, or sorry, other liquid instruments that are accepted as a means of payment. So the entire supply of that circulates in a country at a given time, called the money supply. So that means that the money supply can include things like cash, coins, and balances held in checking and savings account. So what the money you have in checking account, the money that every person living in the US having checking account or savings account are part of the money supply. So in other words, we can say there are a few things we need to know about money supply. There are a few things I would like to look at. First one is that the money supply actually reflects the different types of liquidity each type of money has in the economy. So when there are different types of money supplies, which we will see in a few minutes, but each of them reflects the different type of liquidity that the economy has at that particular time. The second thing that we need to know is that the Federal Reserve Bank, which is a U.S. central bank, is a bank regulator and is responsible for monetary policy and other policies that have to do with the money supply. They have responsible for monetary policy and other policies that affect the money supply. That's the best way to put it. Now, the money supply, there are different types of the way of describing them. The first one, we have the one we called MO or M1, which is basically known as, or commonly known as the narrow money. Now, the narrow money includes coins and currency in circulation, plus the demand deposit. That is the amount you put in the bank and which you can withdraw anytime you want. Travelers' checks, their value, and other checkable deposits. So we call it road money. So M1. So another name for it is near money, because it is very liquid. If you have money in your checking account, you can always get it fast, withdraw it and use it anytime you want. There are ATMs everywhere. And if you have cash, very liquid, you can just go to the store and buy things with it. And so on and so forth. So the M1 and M0, or what they call narrow money, is the most liquid portion of the money supply, as measured with as is measured by M1. The reason being that it contains currency and assets that can quickly be converted into cash. You can easily quickly convert your traveler's check into cash, and the other checkable deposit you can easily convert it into cash as well. Please, can you mute yourself? So, this further describe the features of the broad money. Narrow money, near money. I mean to say not narrow money. M1's money supply. You see that it's a narrow concept of money and measures the amount of money circulating in the economy. And like I said, it includes coins, currencies, overnight deposits, and it is the most liquid description or the most liquid type of the money supply that we have. Yeah. Now, the second type of, another way of describing the money supply is what they call near money. Excuse me, let's see. Yeah, this one narrow money. One is near money. The near money is the M2. The symbol we use to represent it is the M2. And it is a broader classification of the money supply because it includes M1, then plus savings account, plus time deposit account. Time deposit account, you don't have access to it until the time that you stipulated that you withdraw it reaches or expires. So that's why it is not as liquid as the M1 classification. Then the individual money market mutual funds balances are also included in this classification. So you include M1, then plus savings account, plus time deposits, then the individual money markets, mutual fund balances. So all these are their money, part of the money supply, but they're not as liquid as the M1 classification. Remember, M1 classification includes currency and coins, plus demand deposits, plus travelers' checks and other checkable deposits. They are more liquid, but the M2 is more of part of the more include other components that are not as liquid as the M1, but it includes part of the M1 as well. Then the other one, which is the M3, is the money of is a measure of money supply. That classification includes the M2, then plus time deposit, plus money market funds, plus short-term repurchase agreements, which is less liquid, then plus larger liquid assets. Now, every country decide how to classify their money supply, but US usually uses M1, M2 as the classification for their money supply. So now, according to the data from the Federal Reserve, almost $3.7 trillion in M1 money was in circulation in US as of 2018, while more than 14.3 trillion in M2 money are in circulation in US at the same time. So for us, the student, both the student and professionals and all professors, we need to know to understand the definition of money supply. Like I said, each country chooses a classification that we use for describing their money supplies. So well, one thing that is that counting and tracking the money in the modern economy doesn't just involve the paper bills and coins. Money is also closely linked to bank accounts. So even if you use a credit card, or let me say debit card or checks, they are all linked to your bank accounts. Okay. Now, which this leads us to the next concept, which is the looking at banks as financial intermediaries. An intermediary simply means somebody or something that stands between two parties. In this case, we're looking at the lenders of cash and then borrowers, people who provide cash and people who use the cash. So banks serve as an intermediary, financial intermediaries, because they bring savers and borrowers together. So without banks, the means of making payment in this modern day will be very difficult. Most of the transactions you make, whether it's a transfer, even if you use Cash App with some mobile payment system or a Western Union, all of those things go through the banks. So banks are a critical intermediary in what is called the payment system, which help the economy exchange goods and services. So, and people with extra money that they would like to save can store that money in the bank instead of looking for individual who will keep it for them or who will borrow it. People usually store their money in the bank so that those who want to borrow the money can go to the bank or apply for credit cards. Now, so that serving as a financial intermediary make it easier and faster for people to borrow money. Like now, if you want to borrow money, you don't have to start looking for somebody who will lend it to you. That is will be an uphill task. Of course, you can contact your relatives, but it's not always, it doesn't always work out all the time. But you can go to your bank or apply for a credit card. And if the money is needed urgently, you can use a credit card to make a cash advance to get the money fast, instead of going to people and then looking for the charity in terms of lending you some cash. So bank eliminate that for a lot of people and make it fund available for those who need it to start business or to conduct any form of transaction, financial transactions. So this leads us to the Federal Reserve System and the central bank. Other countries, the general name for it is the central bank, but some countries have unique name for their own. For example, in the US, it is called the Federal Reserve. The main function of the Federal Central Bank or the Federal Reserve System in the US is to conduct monetary policy and to ensure that the nation's financial system operates smoothly. So usually most nations have central banks or what we call currency boards. Now in England, it is called a European in Europe, European Union. They call it the European Central Bank. In Japan, it's called Bank of Japan. And in England, it is called Bank of England. So now a natural question to ask now becomes, what exactly does the central bank do? Now, three main functions. First one is to conduct monetary policy. I'm going to elaborate more on what monetary policy is. Second one is to promote stability of the financial system. Then we're going to get through that soon too as well. And the third one is to provide the banking services to commercial banks and other depository institutions. Not only that, they also provide banking services to the government. Let me make it number 4. They provide banking services to the government. Okay. Let's look at this, some of these things in a more elaborate as we look at the other functions of the central banks. Now, any question before we continue? Hello, class. Any question?
No questions.
Okay, good. So now, remember, I just mentioned the main function of the Federal Reserve or the central bank to conduct monetary policy, promote stability and the financial system, and then to provide banking services to commercial banks. Now, the same services they give to us and to commercial banks, they give to commercial banks. I think what I'm trying to say here is that the same services that banks give to us, that they accept our deposit, help us in finalizing our financial transactions. They do this, the Federal Reserve or the central bank does the same for the government, both especially the federal government. They provide banking services for them. We're going to look at this, some of these things, and also we'll also look at the other functions of the central bank, things like bankers bank. I've already mentioned it because I said that they provide banking services to commercial banks. But when we call them bankers bank, it means that all commercial banks has an account, just the way we have an account with our bank. So commercial bank also have accounts at the Fed, which is the US Central Bank. So in those accounts, the commercial banks keep the deposit reserve and they can obtain loans from the Fed through the discount window. So that's one important function that is included in the other functions of the central bank. Another one is this, that the Federal Reserve, which is the central bank for US, ensures that enough currency and coins are circulating through the financial system to meet public demands. So then the third one is that they are responsible for making sure that banks are in compliance with all the consumer protection laws. For example, banks are forbidden from discriminating on the basis of age, race, gender, and marital status when they come to making loans. Okay, they are also required to publicly disclose information about loans they make for buying houses and how those loans are distributed geographically to make sure that they comply with the applicable laws at the time. Now, another function that is included and under the other functions of central bank include processing checks. All these checks you use to make payments. When you deposit the check in your bank, then you get the money. But the process did not start there. There are a lot of processes that have gone to make sure that you get that money. They might give you the money. Sometimes when you deposit check, the money may not be available immediately because you have to go through those processes. And the Federal Reserve or central bank makes sure that those checks are processed. So when you write a check to buy groceries or for anything at all, any purchase, the grocery store deposit the check in the bank in their bank accounts, and then the physical check will now be returned to your bank for payment. After which the fund is transferred to the bank account of the grocery store. So the Federal Reserve makes sure that or is responsible for how these transactions are handled. Once the check leaves the cash register and is deposited in the store's bank account, make sure that the money comes to the store. They receive that money. So a natural question to ask at this point is this: does that mean that your check to the grocery store or the check that you use to buy things or to pay your rent, does it mean that all of them go pass through Washington, D.C., where they have the Federal Reserve is? Actually, no, because I think it was in 2000, I think in 2003 that the Federal Reserve made a law because it's called Check 21 Act of 2003. That check that removed the barriers to electronic collection of checks. That means that the check don't have to travel to Washington. But a copy of it can be maybe captured and then be transmitted to the branches of the Federal Reserve where it will be cleared. So there are a few things we need to know about the check Fed and the check processing. The first one is that the Federal Reserve Bank check services offer bank customers a lot of electronic and paper check processing options. So when you buy with a check or make payment with a check, there's a way other, or if you deposit a check in your account in the bank, there are many options that can be used to process the check. Sometimes you can go to the store. I remember the time we used to have check cashing services in some stores, liquor stores, for example. When they cash the check, charge you amount, then deposit the check into their account. Then it go through a lot of process of clearing and then processing so that they will get the money. And then the money will go into their accounts. So, but throughout the 20th century, paper checks were one of the most common ways of people make payments when they buy things. Payment for rent, payment for groceries, and so on. in the year 2000, the Federal Reserve system has 45 check processing centers around the country, so that they use planes. When the stores collect that checks, they use planes to transport those checks to every night to get them to the location where they will be processed. But all that is very cumbersome and very challenging task to accomplish every night. So in those days, checks doesn't process immediately. Sometimes they take 2 days, 3 days to process before you can have the money in your account. But now, all those things changed in 2003 when I think I mentioned this before, when the Federal Reserve started adopting the Check 21 Act of 2003, which is a 21st century law that allowed a picture of a check to act as a legal documentation that the check had actually been paid. So they don't have to use aeroplane to transport them anymore. They can just capture the picture of the face of the check electronically and then transmit it to those the branches where they can now be cleared. So this rule, Check 21 Act of 2003, really to a very large extent, to a significantly large extent, reduced the need for paper checks. So you don't have the, like I said, they don't have, of course, you write a paper check and use it to make payment, but now the stores had just captured the image and transmit it to the Federal Reserve system, or the bank where you deposit this check. You just capture the image. You don't have to move the paper check anymore, so long as it's a genuine check. So now this leads us to monetary policy. Before I explain monetary policy, I want to refer you back to what I said here, that one of the functions of the Federal Reserve is to conduct monetary policy. So now, what is monetary policy? Now, monetary policy means it means managing the money supply, interest rates, and credit conditions, so as to influence the level of economic activities in the country. So, what it means, this means that the Federal Reserve intervene in to make sure that the country maintain a specified level of economic activity by managing the money supply, the interest rates, and credit conditions. So this is let me explain how the Federal Reserve execute the monetary policy. There are usually 3 major ways they do it. One is the open market operation. The second one is the changing the reserve requirements. The third one is changing the discount rates. So now let's look at each of them. Let's look at the open market operation. Under open market operation, what the Fed does is to buy and sell government securities. They buy and sell government securities in the open market, so that either to expand the money supply or to contract the money supply. So when they buy the bond, they pay for it, so that to the banks, they buy it from the bank and then pay for it. That will increase the amount of money that the banks have. And when they have a lot of money, they want to lend out. So as banks are lending out so much money, people are borrowing to make projects. It will increase the money supply. And when the Fed want to have less money in circulation, they can sell the bond instead of buying it. So when the banks buy those bonds, they will have less money to lend out. That will reduce the amount of money in circulation. So that is one way of they do these things. So this is open market operation is a common tool that Fed use, and then the Fed have what they called the Federal Open Market Committee that they decide actually what to do with respect to the monetary policy. So with the Federal Open Market Committee, they exact the monetary policy by setting the targets for the federal fund rate and then implementing the open market operations and other tools that they use. So let's see how the Fed implement open market operation. Open market, like I said, open market operation is the sale of federal bonds or the buying of bonds to either increase or control the money supply or the amount of money in the hands of the commercial banks. So when the Fed buy bonds, money flowing from the central bank to the individual banks in the economy increases the money supply and the amount of money in circulation. When they sell bond, then the opposite is the result, which means that they reduce the quantity of money in circulation. So another tool they use is the changing the reserve requirement. You can see that's number 2. Now, when the Fed changes the reserve requirement, that means they raise the lower the reserve requirement, which is the percentage of each bank deposits that they have with the Fed. So if the bank required to hold a greater amount of money in the reserve, that means they have less money to lend. But if if the reserve requirement is lowered, let's say that the Fed said that 30% of all your reserve. Let's say that the bank have $1 million. Let's say, as an example, and the Fed say that you're going to put 30% as a reserve requirement. That means the bank must keep 300,000 with the Fed and have only $700,000 to lend out. So, but if the Fed say, okay, the bank reserve will be 10%, that means that bank will keep 100,000 in there with the Fed and have 900,000 to lend. So when they increase it, bank have less to lend out. When they decrease it, they have more. All this is just to regulate the level of economic activities. When the bank reduces the amount of the reserve requirement, bank can lend more. And that means people can borrow money and do projects, and that can cause the economy to heat up, and become which can lead to inflation. So when they do it, the Fed when the inflation becomes the problem, that means the economy is heated up, too much cash circulating. The Fed would like to withdraw some of them, like they're doing now by raising the reserve requirement, for example. And that means the bank will have less to lend. And when they have less to lend, people have less access to cash, and then gradually the amount of money in circulation will decrease. So another one is discount rate. The federal discount rate is the interest rate that the Federal Reserve charges banks on loans that they extend to them, So if they raise the discount rate, that means that the commercial bank will reduce their borrowing of reserve and instead cough in loans to replace those reserves. This again will reduce the amount of the money supply. If the central bank lowers the discount rate, it will, increase the money supply. There's one particular aspect, we call it the federal fund rate. I'm sure you must have heard of this. Now, the major way that the banks make money is they might borrow from the Fed. I think I'm going to show you here. They might borrow from the Fed, borrow at 1%. Give me 1 minute. Let me put this up. Yeah, the bank might borrow from the Fed. Banks, I'll make it big. Banks borrow from the Fed at 1%, for example, 1%, and then banks lend to us, depending on our credits, out, okay, money at 3%. So that means they make a profit of 2%. That is what the main way the bank makes their major their income, most of their income. So now sometimes when the Fed raises the federal fund rate, federal fund rate simply means the target interest rate that is set by the Federal Reserve, at which commercial banks borrow and lend their excess reserve to each other. Like for example, they say that Bank of America, especially this Super Bowl weekend, more people are withdrawing money from their account in Bank of America, for example, and that means they all of a sudden they run short of cash. Bank of America might go to Wells Fargo and borrow money from them overnight to meet up with the cash demand. See, so now, if the federal fund rate is high, if the federal government reserve say that okay, the rate is that because Bank of America will get that money from the Fed. They borrow from the Fed and lend to you Wells Fargo will get the money from their reserve of the Fed and lend to Bank of America, for example, in this example. So if the Fed say okay, the federal fund rate is 1%, that means it's less. Bank of America can borrow more and lend to Wells Fargo can borrow more and lend to Bank of America. Next week, the team might reverse. It might be the Wells Fargo that needs extra cash that they need in overnight. They might decide to go to Bank of America or other banks to borrow it, depending on the federal fund rate. Now, if that the Federal Reserve, like they are doing now, decided to raise the federal fund rate from 1% to 4%, to 4%, for example, that means the cost of borrowing will be high. See? Now, if Bank of America borrow this money, that means to lend it out, they have to lend it out at least 5%. Okay? They lend it out to at least 5% in order to make profit. That will cause the interest rate to go up. The interest rate you pay for credit card, loan, car loan will go up. So you hear people saying, oh, the interest rate is so high. Let me postpone buying this new house because the rate is too high. So what I'm trying to say here is that when the Fed raised the federal fund rate, people tend to borrow less. And in the long run, this will reduce the level of inflation. Now, if they reduce the federal fund rate, that means the cost of borrowing will be cheap. That's when you see people buying cars, buying new things, credit cards, and then in the long run, it might lead to inflation. Say, but it might create jobs. It might create jobs because people borrow, businesses borrow to do projects that will create jobs. And people now get jobs and they spend. The economy keep growing, but then it becomes heated up. Inflation goes up. Then the Fed says, okay, let us lower the inflation. Usually, when they want to lower the inflation, they might do it at the cost of high unemployment because that means they cut their rate. They'll set it will cost bank to get less demand for loanable fund. So there'll be less projects done. People postpone their projects, and then that means no job is being created. Less, jobs are not being created. That will increase the unemployment rate. So that is, you can see that the Fed, their actions in many ways influence how the economy works. With their monetary policy, they can influence the economy a lot with respect to things like inflation, unemployment, and others. Any question? Any questions, scholars, before we leave?
No questions.
All right. So well, I will encourage you to read up these are actually self-explanatory. Read them up. Read the chapter for the week. Do the week assignments. And I will see you next week. Okay.